Commodity overview and catalyst breakdown. Crude oil futures are accelerating to the upside today, with West Texas Intermediate reclaiming $78.09 per barrel while international benchmark Brent crude advances toward $83.49 per barrel. The primary catalyst driving today's price acceleration is a sharp re-emergence of geopolitical risk premiums across key Middle Eastern transit corridors. Headline concerns regarding maritime shipping access through the Strait of Hormuz have reignited fears of short-term physical supply bottlenecks for international refiners. As commercial shipping operators adjust transit protocols along Persian Gulf export routes, spot crude markets are pricing in prompt scarcity, handing immediate pricing power back to upstream energy extractors. Macro drivers and central bank forces. To evaluate the broader macro environment for crude, we must monitor foreign exchange momentum and central bank interest rate trajectories, with the US dollar index, DXY, consolidating near 99.85 ahead of upcoming US jobs data. Currency headwinds for dollar-denominated energy commodities remain limited. When energy input costs experience sudden upward spikes, higher retail fuel prices feed directly into headline consumer price index prints, complicating the Federal Reserve's path toward interest rate normalization. Furthermore, with Strategic Petroleum Reserve (SPR) stockpiles remaining constrained relative to historical baselines, government policy options to artificially suppress future energy rallies via emergency releases remain structurally limited. Physical inventories and supply-demand dynamics. Turning to fundamental supply dynamics, the latest weekly status report from the U.S. Energy Information Administration confirms ongoing commercial crude stockpile draws across key domestic distribution hubs. While U.S. domestic crude output continues to run near historical highs, commercial refinery throughput remains elevated to meet robust global demand for finished transportation fuels and middle distillates. At the same time, OPEC+ quota policies and capital discipline among U.S. Permian Basin producers prevent aggressive oversupply, keeping physical market fundamentals tightly balanced against geopolitical shocks. High-impact USA stock winners. For U.S. equity investors, crude oil trading near $80 per barrel generates substantial free cash flow yield expansion for large-cap integrated energy majors. The premier upstream leader in the U.S. market is ExxonMobil, NYSE, XOM, operating with low break-even extraction costs and massive global refining scale. Every $10 expansion in realized crude pricing adds billions in operational cash flow to back share buybacks and growing dividend distributions. Our second key energy winner is Chevron Corporation, NYSE, CVX. Chevron features a fortress balance sheet and premier Permian Basin asset positioning, allowing it to capture expanding operating margins during energy rallies without incurring capital expenditure inflation. For broad sector exposure across upstream producers and equipment service providers, the Energy Select Sector SPDR Fund, NYSE, XLE, offers a liquid, high-yielding vehicle to capture ongoing energy sector momentum. Squeezed USA stock losers. While upstream energy extractors capture high operating margins, sustained crude rallies act as a direct input cost tax on energy-intensive downstream U.S. business sectors. Commercial airlines represent the primary wave of margin compression, as rising jet fuel spot prices directly erode quarterly operating margins when ticket pricing cannot immediately offset fuel cost inflation. The second major sector facing earnings drag includes global freight, trucking, and supply chain logistics networks. With wholesale diesel fuel prices rising alongside crude benchmarks, fleet transportation costs compress net margins for carriers lacking automatic fuel surcharge pass-through mechanisms. Tracking these input cost pressures allows you to protect portfolio performance by avoiding margin-sensitive equities during sustained commodity price shocks. Forward look and technical roadmap. Looking at the technical chart roadmap for WTI crude futures, $74.60 per barrel serves as primary institutional support, with $78 acting as a key short-term floor. To the upside, a confirmed breakout above $83.80 opens the technical pathway toward the major resistance target band between $85 and $88 per barrel. Over the coming week, market participants will monitor official AIA weekly petroleum reports, U.S. non-farm payroll numbers, and diplomatic updates regarding Middle East shipping routes. Maintain a disciplined allocation approach by using short-term price pullbacks towards support as potential accumulation opportunities in Tier 1 energy majors like ExxonMobil, XOM. To see how crude oil movements connect directly to our broader stock market coverage, click the video on screen right now to watch our full US market breakdown. Make sure to subscribe to Global Macro Pulse, and we will see you in the next update.